it back to Doge real quick. Okay, bring it back to Doge. We came into that POI. We came into that 12-hour breaker right here. And it was actually a double breaker. Okay, so we came into this double breaker. And initially speaking, I was watching this right here. You had your 1, you had your 2, and this could kind of be the model 2 distribution schematic, okay, where you have the range high, you have the range low, and then you get that first deviation coming back or mitigating your resistance, also sweeping that also good looking liquidity on the left right here, coming into your resistance, which is always nicer because if you have obvious looking liquidity there, you just know that if you come in there, it can give the market maker the opportunity to fill more shorts because it was obvious looking liquidity, right? And then I was watching a 1, a 2, price pulled back exactly to the POI we wanted it to pull back right here. And then price pushed back up again. So I extended that range high to the deviation high like we always do. And then right here, we had another 30-minute supply zone. So I'm kind of going to draw to that first tap, going to put the 30-minute supply in there. Boom. And that was it. Now, looking at the supply zone, we can see, that price, the way the supply was created was from this candle's low, and then we pushed up, and then we dumped back down, where the true inefficiency candle of the move down was right here, this candle. After that aggressive pop down, from there, price started curling down, okay? Therefore, making this immediate mitigation a nice liquidity target, okay? That way, price kind of comes up, sweeps all that liquidity that we left behind, and then we can actually come down more, potentially confirming that third tap. So even though we tapped that supply right there on the 30-minute time frame, technically validating this model 2 distribution, if we could break structure, I didn't really like it because also from a vertical perspective, your third tap is very low compared to your second tap, and that also decreases the RR, but also it's not, how fast can you de-risk yourself actually, because you're kind of entering in, I think, on the EQ line of dividing premium into normal premium and extreme premium, so I wanted that liquidity to get swept because it just was so obvious. And that's what we did, right? That's what we did. But right here, you kind of had a range, right? And I posted about this. Hey, if we can get TCT within TCT, that's definitely going to be a short setup. And as you can see, we only got a 2-tap model, and then we went down. And since you're now creating a range, you cannot base a confirmation of a market structure break like this on the higher time frame. You actually have to watch a range break, which is always shittier. That's why having TCT within TCT, where the low time frame model doesn't give you an entry, is actually really shitty, because then you have to watch for a range break where you actually have to leave the DL2, which decreases the RR. So let's say this was a model 2 distribution, but there was no confirmation in this model itself. Then you have to watch for this range to be broken. And you can't watch for a simple close like this, otherwise you would have gotten trapped. No, now you need to pull on your DL2 and actually wait for a proper range break, which is just shitty. So if you have TCT within TCT, but the low time frame TCT model doesn't give you an entry, that's kind of like, man, really? You're going to do me like that? So there was no confirmation in here to short at all, but at the same time, I have a hard stop. I'm trying to get that sleep schedule perfect, because the better you sleep, the also better you perform, okay? Because you have to think a lot and you need to be mentally sharp. So trying to get in bed always, or be ready for bed at 12 and get up at 7 to get those 7 hours in. So I wasn't watching price action in here anymore, but there was also no confirmation. Now, then we moved up higher, and you can still look at this as one big play, right? You can still look at this as one big play on kind of like the 45-minute, where you have the high, the low, the high, the valid pullback, and then the push up again. Technically speaking, this is valid, but if you have to be rational, okay, and you have to think what actually looks better, I'm going to zoom in here. What you can see after price mitigates its demand, goes up, we actually had our own little model 2 distribution in here. We had our own model 2 distribution in there. And I was like, is this going to be like a situation where you have, a TCT within TCT, like we were just talking about? And then I identified this because I wasn't awake for this price action, because I get up at 7. I'm like, I'm dragging it a bit, right? It's getting dragged a bit. If you have to pull your starting point all the way from here, is this truly horizontal price action, or is this just price action going up, right? So I checked that, also understanding that we did have that demand here, right? And typically, what I always say about, your first starting point, if you kind of had a V shape leaving behind demand, maybe it's better to start the range from the second point if, price is kind of dragging it upwards. So I posted about this. I'm like, hey, this can still be a Model 1. And then I kind of decided to change my perspective because I was like, I think I'm dragging the model a bit, because just looking at structure, this actually looks very clean, making a higher low and a higher high just like this. So I was like, okay, let me draw the range differently from this starting point. And I looked at this and like things immediately clicked more. I was like, oh, this looks way better, right? This looks way, way, way better. Where in this range, you cannot even make one argument for there being demand. Like there's no demand in that push up. And then I'm like, okay, this can be now a Model 1, a 1, a 2, a 1, a 2, a 3 right here. Let's extend it. Where on your second and third tap, you kind of also had your own little Model 2 distribution in there. And then I'm referring to 1, 2, and this local pullback 3. So I am checking, okay, was there actually a entry on the low time frame right there? So I go on the 1 minute and I'm like, oh, but there wasn't. And then you're kind of in the same situation like I was describing earlier, because since this is actually a technically valid low time frame model, there was no confirmation. So if you want to have a proper breakup structure to confirm the bigger model, it's now a bit sketchy because this was truly its own little range. You can see how clean that looks, right? There was just no confirmation. Now, this all developed when I was asleep, right? I'm not aware of this price action in a live trading environment. So I'm seeing price come down, and I believe there was one demand zone. Yeah, there was one demand zone right here, and price mitigated it. And then we started making our way back up. So I'm like, okay, now this can be interesting, right? Because on the high time frame, this is your Model 1. That is like, from a Model 1 trading perspective, you can say I'm watching the most local structure and I'm confirming it, but it's a bit sketchy since that was truly its own little range. And I'm like, okay, well, maybe it can go over in the Model 2 because this demand is tapped. So if we go up from here, leaving also a local liquidity trail, there's my trade. So I'm seeing price grind up here, and I'm like, oh, maybe this can even be a trendline liquidity at that point in time. And I'm like, oh, wait, it is. I can literally draw this like this, and I have beautiful sell side trendline liquidity. So I'm like, okay, where is my extreme supply, right? Where is the extreme supply? Now, on the 30-minute, you can use this entire thing as your extreme supply, okay? And that is technically valid. And we also mitigated that and went lower. This 30-minute order block right with the third tap. And you can also see from a candle structure perspective, if you actually pay attention, you could kind of expect price to push up because look how you were leaving these highs behind right here. 1 high, 2 high, 3 high, all lower than each other. But if you actually pay attention, you can see right here, I was just referring to this 1, to this 2, to this 3. So even though this is overall the entire supply zone, the actual market maker supply is the low time frame structure supply of this multiple candle pullback before aggressively expanding down, leaving an efficiency of this low time frame model. And look at that. Picture perfect tap. Now, once that is mitigated, there is no reason to go higher because the market maker supply of the most refined model within the bigger model has been mitigated. And the way you come up here also locally from this low into that point, you're leaving a beautiful trail of liquidity where price is just like each candle is almost going higher than the previous one. Each candle's low is higher than the previous one, almost, this entire move up, right? Now, the fact that there is a 5-minute supply zone above us, it doesn't matter because that supply zone is simply there because of timing. It's not that price can come higher to then tap that 5-minute supply. No, the market maker supply of the most low time frame model within the bigger model, within the bigger 30-minute market maker order block has been mitigated. So that's why the moment I get a 1-minute structure break, you can enter. It's in those tiny details of understanding that there should be no more reason for the market maker at that point in time to go above this high that allows you to get the most refined entry and therefore the best RR. So you go short right there on the breakup structure, stop loss goes locally, and then you target that low. Now, what price actually did is we came down aggressively, leaving against supply behind, kind of creating a supply chain where this structure supply created that structure supply. This market maker supply created that market maker supply because the moment you break it, this tap confirms. So you kind of have an extended distribution model where in the third tab from the model 2 perspective, you create supply. So you literally have market maker supply creating market maker supply, aka a market maker supply chain, while continuing this trend line sell side liquidity. So the moment you mitigate that and you break structure, again, you can trade the lower high. That's the fourth tap I'm always talking about, guys, you know? So the moment we broke it right here, I was already very well positioned on that break of structure. So I simply trilled my stop loss from this high to this high, because the moment you break structure after mitigating supply, there's no reason to go higher from a supply nor liquidity perspective. And then price kind of pushed down very aggressively, right? So that is the reasoning behind why I took that trade. And it was an absolute beauty. But understanding those tiny details of like, hey, we actually had our own little model in here that left behind its own little market maker supply that we can come back for. You know, you're combining distribution within distributions, and then you just know that yeah, that's gonna work. So also looking at this, you can see this is a such cleaner range right here than if you compare the range from all the way down here. You know, this was kind of its own little price action looking back, but you have to realize that in the moment. You kind of have to redraw it, because in the beginning, I also did not see it like at once. But then I was like, okay, wait, we actually have demand there. This was the first time we created supply. I kind of have my own model in there. Is this not going to be the better range? And then when you draw it, you actually immediately realize, yeah, that's the better range. So a lot of technical moving parts behind a setup like this. It's not just a 1, 2, 3, but understanding those tiny little things of, okay, man, we had a model within a model, market maker supply, so this must have been the exact pivot point that they shorted. You know, above this, there's no reason to go higher. Then it's just invalidated. Coming back to the demand, truly, and the demand test right here, guys, if you want to see, or if you want to understand the actual reason why they come to the demand before putting in that tap, it's not to give us an entry, right? It's not to give us an entry. Wyckoff is all based behind the ratio between buyers and sellers. So what they do is they come to points in the chart where there is demand, and they test the strength from the buying side to know if they're well enough positioned to dump price down into their favor for shorts. So it's kind of measuring the ratio between buyers and sellers, what they do, which is probably algorithms, right? But they test it, which makes, for us, it's beautiful, because then that demand is not there anymore. But they tap it to test it, how strong support is. And if they see that the ratio is good, they're going to dump it back down. If the demand is too strong, you know, you're going to go higher. That's why that's the case. And you'll often see those demand taps before confirming the third tap. You know, also right here, let's say we did confirm the third tap, we did come back to demand to test it, right? For us, it's like, oh my God, let's hope that we mitigate demand before going to our third tap, because then it's not there anymore. But the actual moving part behind it, from a Wyckoff perspective, the theory is they test demand to see how strong it is, okay? So I kind of went on a rant there, but I think that's pretty valuable.